credit score do I need to get a mortgage? The credit score needed to secure a mortgage significantly varies based on the type of loan you're applying for. For conventional loans, which are not backed by any government organization, most lenders require a minimum credit score of 620. However, applicants with higher credit scores, specifically those at 740 or above, usually qualify for more favorable interest rates and better loan terms, as they are deemed less risky borrowers. If you are considering an FHA loan, which is backed by the government and designed to assist borrowers with lower credit scores, you could qualify with a score as low as a 500. However, this would likely require a larger down payment of at least 10% or other compensating factors. If your credit score is 580 or higher, you may only need to provide a 3.5% down payment. For VA loans available to eligible veterans and active duty service members, there is no official minimum credit score established by the Department of Veterans Affairs. But still, most lenders typically prefer borrowers to have a score of 620 or higher. And lastly, USDA loans aimed at facilitating home purchases for eligible rural and some suburban buyers generally require a minimum score of 640. Nevertheless, some lenders show flexibility and may accept lower scores if your overall financial situation is strong and stable. It's important to remember that while credit score plays a crucial role in mortgage approval, lenders also assess various other factors such as your income, debt-to-income ratio, employment history, and the amount of down payment, all of which can help mitigate the impact of a lower credit score. How much do I need for a down payment? The required down payment for purchasing a home can vary significantly depending on the type of mortgage you choose and your individual financial status. In the case of a conventional loan, most lenders prefer a down payment of at least 5%. However, certain programs may allow qualified borrowers to secure a mortgage with as little as 3% down. For FHA loans, the minimum down payment is set at 3.5% for borrowers with a credit score of 580 or higher. If your score falls between a 500 and 579, you will likely need to put down at least 10%. VA loans, which are provided to veterans and active duty service members, as well as USDA loans tailored for eligible buyers in rural areas, often allow for no down payment, presenting an attractive option for those who qualify. With that said, it is worth noting that even when faced with low or zero down payment possibilities, providing a larger upfront payment can be advantageous. Doing so can lower your monthly mortgage payments, decrease the total interest you'll pay over the life of the loan, and can help you avoid private mortgage insurance, otherwise referred to as PMI, on conventional loans, which is an extra cost added to your monthly payment when your down payment is less than 20%. What documents do I need to apply for a mortgage? When preparing to apply for a mortgage, being equipped with the necessary documentation is crucial for streamlining the approval process and demonstrating your financial reliability to lenders. Standard required documents commonly include proof of identity, such as a government-issued photo ID, along with your social security number. You will also need to present recent pay stubs, typically those from the last 30 days, to establish a clear picture of your income. Additionally, lenders will ask for W-2 forms from the previous 2 years and, if applicable, tax returns if you're self-employed or have multiple sources of income. To verify your financial assets, you'll also need to provide bank statements from the past 2 to 3 months, which will confirm that you have adequate funds for your down payment and closing costs. If you receive any additional income, such as from rental properties, alimony, or bonuses, be prepared to supply relevant documentation for those as well. Should you have any outstanding debts, it's important to have account statements or payment histories on hand. Furthermore, You will need to authorize a credit check, and if you're already under contract to purchase a specific property, a copy of the signed purchase agreement will be required. Having all these documents organized and readily available can significantly expedite the mortgage approval process. How long does it take to get approved for a mortgage? The timeline for obtaining mortgage approval can vary widely, but on average, the overall process generally takes between 30 and 45 days from the moment you submit your application until the loan is finalized and closed. The initial stage of this process, known as pre-approval, where a lender assesses your basic financial details like income and debts, can be completed in just 1 to 3 days. Following pre-approval, the full approval process begins, which includes a thorough verification of your income, credit history, assets, and employment status. This stage also encompasses an appraisal of the home you wish to purchase and a meticulous review of your financial documents. Delays can arise during this process due to missing documentation, appraisal issues, or if any questions arise during underwriting that require further clarification. By being well prepared with your documentation and responding promptly to any requests from your lender, you can help keep the approval process on track and potentially reduce the overall timeline. What is the difference between mortgage pre-approval and pre-qualification? Mortgage pre-approval and pre-qualification are both essential steps in understanding how much you may be able to borrow, but they differ in their depth and thoroughness. Pre-qualification is generally the simpler and quicker of the two. It usually entails sharing basic financial information, such as your income, debts, and assets, through an online form or over the phone, without any verification of documents. This process provides you with a general idea of what you could potentially qualify for, but it does not carry any weight as a commitment from lenders. On the other hand, pre-approval involves a more in-depth process wherein the lender meticulously reviews and verifies your financial documentation, including pay stubs, tax returns, and credit reports. This process not only gives you a more accurate picture of your borrowing capacity, but it also results in a formal letter indicating how much you are approved to borrow. This pre-approval letter can be a critical tool in the home buying process as it demonstrates to sellers that you are a serious and capable buyer, thereby enhancing your position in negotiations and significantly increasing your chances of securing your desired property.